All right. Thank you everybody for joining me here today. So as I was saying, over the last couple of months, I've taken a lot of phone calls and a lot of different questions on student loans, and I've noticed a couple of trends in particular associated with this pandemic, how it's affecting student loans and what's going on out there. So um, I want to touch upon a couple of those topics first, then I certainly want to open it up for questions, so I can try to really answer everything that's on your mind and the things that you guys are dealing with on a daily basis. So, the first biggest trend that I've noticed out there is I've seen a lot of first time borrowers. People may have not have ever had to borrow a loan before. They've been paying for college on their own, but because of the pandemic and everything that's happening economically in this country, families are starting to have to turn to loans for the very first time. So, a couple of tips for people who are out there looking for student loans the very first time. The first thing you should be aware of is you should always apply for financial aid first. Fill out your forms for financial aid, such as the FAFSA form. This is going to give you access to very low interest rate loans from the federal government. They're not going to cover everything. They generally don't, but that's where you always want to start. And I've seen people who are used to coming into student loans for the first time. They're not applying for a financial aid, and that is definitely something you should always do first. The second thing that's kind of important for people looking for loans for the first time is do your research. Look around a little bit. Try to look at the different benefits each individual lenders may offer. Look at interest rates and try to do your research and find two private student loans that you think are good for you. And then go ahead and take kind of the next steps from there. So, the other big trend I've been seeing related to the pandemic, even for those veterans of the student loan industry, people who have applied for student loans before, they could be thrown a curveball this time. So there's a lot of uncertainty, and the timing has been really affected this year. Schools maybe have not sent out their tuition bills as early as they normally do, giving most people who are applying for a loan a much shorter window to get everything done and get everything accomplished. So the other thing I can see from a trend perspective is there's a lot of worry around that uncertainty with student loans. Do I apply now? How quickly is the school going to get the money? What if things change? What if my school all of a sudden decides to go remote learning and I don't think it's worth it and I decide I'm not going to attend that school anymore? What would happen to my loan? And also vice versa. What if somebody is going to continue to attend even if a school goes to online learning, but they've borrowed some money to pay for room and board under a student loan? What's going to happen to that? How does that going to be affected during the pandemic? There's definitely things to be aware of and things you should consider when looking at those. Mostly it's from a timing issue, so don't ever worry too much about canceling the loans. As long as the money has not been sent out to the school, you can very easily cancel the loan yourself, as well as the school is kind of your backup. They have to do what's called a certification on all student loans, where they have to approve and indicate the dates that they want the money sent to them at. So that's kind of your backup. If something changes on the school and you no longer have room and board charges, that school can also cancel the loan for you to make sure you're not stuck. The last part of that is a good chunk of the student loans, they're spread out. So, for example, if you're borrowing a $20,000 loan, the school's going to take $10,000 for that first semester, and they're going to hold on to that $10,000, and the bank's not even going to send it to the school until the second semester. So that's also going to give you an additional cushion of time in which you can cancel those loans if things change. So that's really what a lot of my more veteran families have been dealing with, is what are those additional changes. But perhaps the biggest thing to be aware of from that timing perspective, as you apply for a student loan, you can get a credit decision and an answer really quickly, usually within about a minute or less. So it should happen pretty quickly. The school will get a notice that your loan has been approved, usually within a couple of days of you closing the loan and getting everything taken care of. Most schools are pretty reasonable that once they get that notice from the bank, they know the money's coming and they're going to let you attend your classes, they're going to let you register. So if you've been one of those families that have been waiting until the last minute because of this pandemic, no, you still have time. You can get an approval notice off to that school pretty quickly, and they're going to be reasonable and let you attend, even though the money may not actually show up at that school for another week or two. So that can still take some time for the money to show up there, but everything can happen pretty quickly right up front. So kind of the third topic I wanted to touch upon before I go to take questions is kind of associated with the pandemic and student loans and just with tuition in general. Even if you're not borrowing a student loan, maybe you're paying out of pocket or you do still have some savings to pay. But there's that big question associated is what if, what's going to happen down the line? What if the school closes? What if, heaven forbid, my student gets sick? If he catches COVID-19 while he's in the middle of the semester and he's forced to withdraw, what's going to happen? So there is this thing that's been around for quite a while, but it's been very popular this year because of the pandemic. It's called tuition insurance. You can kind of protect your investment in your student through this product called tuition insurance. So if something were to happen during the school year, child becomes sick, for whatever reason, maybe it's COVID or it could be another reason that he becomes ill and has to drop out, you can get your investment back and get your money back if you have one of these policies. We don't offer them here at AAA, but a good idea to check out is a company called GradGuard. What you want to do when you're looking at these policies is you have to be very paying attention to that fine print. You want to make sure what's covered under that policy and what's not. So for example, a policy may say, well, you're not covered if the school has to close because of COVID-19 or some other natural disaster. However, if your student gets sick, you could be covered. So read that fine print, make sure the policy covers you. But it's a great idea where for a couple of $100s, you can protect up to $20,000 of your investment in your student and their education. So those are just a couple of the three things that people should be aware of because of the pandemic and everything that's been happening this year, and what they should be aware of. First-time borrowers, always make sure you apply for financial aid, as well as do your research. And those veteran borrowers, just pay attention to that timing. Your school's going to get a notice that the loan's been approved. And if you need to cancel thing, you can. As long as the money hasn't been sent to the school, you still have, you're in great shape to go ahead and cancel those loans at no cost and no charge to you. And then thirdly, look at protecting your investment in your child this year through some type of tuition insurance. So particularly for those first-time borrowers that are out there now, I wanted to try to open it up and take a lot of questions and see if there's any thing I can help answer and get people more comfortable with that student loan process that's out there. So let's see if we have any questions. Okay, so one of the common questions that I get from people all the time is, can I defer my payments? And the answer is yes. You can defer your payments on student loans. They're going to give you options generally on student loans. They'll allow you to do immediate repayment on your loan. They will allow you to do interest-only payments on your student loan while you're in school. You can also choose to defer the payments up until 6 months after graduation. Only caveat with that is I say be aware that during that time you're deferring the payments, interest is still adding up on that loan. So it's not an interest-free loan. They're just allowing you to postpone your payments on the loan. So let's see what other questions I have that are out here. Oh, here's a good one. Do I need a cosigner to get approved for my student loan? Generally, yes. Generally, yes, most people are going to require some type of cosigner in order to get approved for a private student loan. That's because the private student loans, their eligibility is based on income and credit. And most students just don't simply have the income or the credit. They're like any other traditional student, they're going to school full time. They're not working a full time job, and they're young and they don't have a credit history established. So, yes, having a cosigner is generally needed, as well as that's going to give you a chance to get a lower interest rate. So, there is some benefit that comes along with having that cosigner. The most common follow up question I tend to get to that one is, if I have to have a cosigner, can they be released later on? Can my cosigner get off the loan later? Yes, they can. A lot of lenders will sometimes have what they call cosigner release options. And what that means is, after you make so many payments on time on your loan, you can apply to have that cosigner released. The big caveat or major qualification to doing that is the student will have to have the income and the credit to be able to support that loan. If that student is not working full time and doesn't have strong enough credit, they're not going to release that cosigner. So it's a good idea now. Try to build up credit on the student while you can, so that after graduation, you can get that cosigner released as soon as possible. Let's see if I have some other good questions from the audience out here. Here's another good one. So, are the rates on the student loans variable or fixed? So most lenders will offer both types of loans, variable rates or fixed rates. The common question I always get to that a lot of times is, people ask me, well, what's better? Is a fixed rate better, or is a variable rate better? And the answer to that is, really, it comes down to a personal choice. But there are some things you can consider when you're trying to make up that personal choice. So variable rate loans, for example, they tend to be a lot lower. So people that are really focused on trying to get that lowest rate possible, sometimes variable rates are the way to go. There is a little bit of risk with variable rates. They're going to follow the market rates throughout the life of the loan. So those rates could go up in the future if the market rates go up in the future. Now, fixed rates, they're going to be the exact same. They won't change throughout the entire life of the loan, but they tend to be more expensive. They're a little bit higher. But now you've got no risk associated with those market rates going way up. Your loan is still going to have that same low fixed interest rate that you secured when you took the loan out originally. So one thing I think is a good idea, actually probably two tips that you can follow when you're trying to decide whether you want to go with a variable or a fixed interest rate. Rule of thumb is to look at the term of the loan. If you're going to have a short-term loan, meaning you're going to pay this and pay the loan back in full in a short period of time, maybe a couple of years, 1 or 2 years, 3 years, well, then maybe you want to go with a variable rate, because you don't have a lot of interest rate risk over that short period of time, and you plan to pay it off pretty quickly. The other thing you can look at is, a lot of lenders, when they approve you, they're going to tell you what you qualify for both the variable rate and a fixed rate. And if there's a big difference between the two types of rates, that can help you sometimes make up your mind on what your personal preferences are. So for example, if you apply for a loan and a lender offers you a 7% fixed rate, but they're also willing to give you a 2% variable rate, well, that's a big difference. Maybe now you're the type of person that says, well, I'm going to take a little risk on that rate going up. I'm comfortable, because it's such a big savings, taking that risk on that variable rate. Other times you may not see a big difference. Maybe a lender comes back and says, I will give you a 6% fixed rate or a 5.5% variable rate. Well, that's not a big difference. So in that case, maybe you want to say, well, I'm going to lean more towards the fixed rate, because I'm not getting the huge savings for that additional risk. So at the end of the day, it comes down to your personal preference for fixed or variable rate. But look at those factors. Is it a short-term loan? Is this a long-term loan? And what is the difference between the variable rate and the fixed rate? That can help you make up what's the best choice for you. All right, so let me see if some other questions we have here. How long do I have to repay the loan is another question I see up here. Generally, a lot of lenders will allow you to choose what you want to do. You can do a 7-year loan, you can do a 10-year loan, and you can do a 15-year loan. As long as you're borrowing a loan that's usually over $5,000, they'll let you have your choice. But if it's a small loan, they're not going to allow you to take it out to a long term, like 15 years. But some of these factors, which is very interesting to know, and maybe not a lot of people are aware of, but all these factors, your repayment choices, the length of the loan you're going to choose, as well as if you have a cosigner, and the strength of your credit rating, all these factors are going to help determine what interest rate you qualify for. That's probably one of the most common questions I get is, what is your interest rate? What is the interest rate going to be? It's very difficult to say because it's such a broad range. For example, you can go out and look at lenders that are out there, and you could see fixed interest rates that are ranging from as low as 4.25% to as high as a little over 10%. The way you get to those lower base rates is you're going to choose options like immediate repayment over short terms and have really strong credit. That can bring you towards those lower rates. If you're going to do things like, I'm going to defer my payments and then I'm going to take 15 years to repay it on top of that, and your credit's, passable, but okay, not the greatest credit, now you may start to see higher rates. So probably one of the other most common questions I get is, well, do I have to go through the full application in order to find out what rate I qualify for? Most student lenders are going to do applications in kind of two steps. You're going to go out and do an initial approval. They're going to give you a rate quote. You look to see what that rate quote is, and then you decide if you want to move forward with the loan. So if you get a great rate, you can move forward and take the loan and go into the closing process. Or you can simply say, hey, no thanks, I don't want the loan. I think I'm going to shop around and I think I can do better elsewhere. So some lenders will do that on a hard inquiry. Other lenders will do that with a soft inquiry, meaning if it's a soft credit inquiry to give you a rate quote, it's not going to affect your credit score. So as part of your research, that's a great question to ask when you're looking at private student loan lenders. Do you do a soft inquiry or a hard inquiry to give me a rate quote? That can really help you out as a consumer, going a long way in protecting your credit and keeping that rating up. So let me see if we have some other questions that we can take out here. Well, here's a good one. Do I have to apply for a loan every single semester? You don't have to. You can if you want to. Some people like the control over that process. However, I generally don't recommend that, primarily because it's extra work. Most people are going to apply for a loan for what they need for the entire academic year. So if you get a bill in the first semester, and if it's for $10,000, you can simply apply for a loan for $20,000. Just double what's on your bill, and that'll give you a rough idea of what you're going to need to borrow for the year. The lenders are then going to, as I said earlier, kind of split that up. They're only going to send half the money to the school for that first semester. They'll hold on to that second half of the loan for the second semester and won't send it out until maybe December or January, sometime like that. Key about that is you won't be paying interest on it. The other follow-up question I get for that one all the time is, well, if I have to apply every single year, I'm going to end up with 4 years and 4 loans when everything is all said and done. Will they automatically be combined together when everything is all said and done? No, they're not going to automatically be combined for you. A couple things to know. If you do keep your loans for 4 years with the same lender, they will offer you what's called the combined bill. So you'll still have 4 separate loans from 4 years in college, but they're going to send you one bill for one amount. So you might have to pay $500. You're just going to make one single payment to that lender for $500. And when they get it, they will take it and they will split it up to each individual loan behind the scenes. So that makes it a little bit easier on the repayment side if you keep your loan all with the same lender. The other thing about that is you can consolidate the loans afterwards. So if they're not automatically combined, you can go ahead and combine those if you want to. Through a consolidation, it is a separate process, but it's something you can certainly look into after graduation if you're not satisfied with that combined billing type area. Okay, so let's look and see if we have any other questions. Okay, so another question I get, let's see if I can find one that's out here. This question has come in. Is the interest on student loans tax deductible? Yes, you can sometimes get a tax break on the interest you're paying on your student loans. You do have to, I'm not a tax professional, but I know there is an interest break that's out there. And generally what it does is it follows who's ever paying that interest on the loan. So for example, if the student's a primary borrower on the loan and it has a cosigner and that cosigner is paying the interest on that loan, that cosigner could potentially qualify for an interest rate break on their tax returns that year if they're eligible for it. So something to keep in mind, that you can sometimes get a break on that. If the student was the one paying the interest, then they are the ones who could potentially get the interest rate break. So sometimes it's not a bad idea to work with your accountant and see, hey, who does it make more sense for? Does it make more sense for the student or for the parent to take the interest rate break? Who's going to qualify for this deduction, and who will be able to take advantage of it? Let's see if I can come up with any other questions out here. Are there any fees associated with the loan? So that's a good one. Generally with private lenders, most of them do not have any fees. So some things you want to look out for or ask when you're doing your research. Look for origination fees, application fees, prepayment penalties. Most lenders don't offer those or charge those fees anymore, but there could still be a few that are out there, and you want to be aware of them. You want to know what type of additional costs are associated with taking out that student loan that's out there. Let's see if I can come up with any other questions that people might have out here. Okay. I think that looks like the majority of the questions that I have been seeing come through. Here's another good one that's come in. Can I make extra payments on my student loan if I want to? So I think this question comes down to if I take something like an interest-only repayment option, where I'm just making interest payments on my student loan, can I make extra payments on top of that? Yes, you can. When you do, any payments you make, they have to go to satisfying any interest that's accrued since your last payment's been posted. But anything above and beyond that will automatically go towards the principal and start to reduce your balance on your student loan that's out there. So great thing to do if you can make extra payments by doing that. Sometimes you can end up saving thousands of dollars over the life of the loan on your student loans. Just something as simple, is an additional $25 every single month could save you over to $2,500 on a standard 10-year loan. And that's a pretty simple thing to do. You can just cut out going to Starbucks one day a week. And next thing you know, you've got that extra $25 in your budget, and you can redirect that to your student loan to try to save a lot of money. See if we get any more questions. I don't see any more questions out here, so I just wanted to thank everybody for joining today, coming out. and spending some time learning about student loans, especially the effects of the pandemic have had on our student loans this time of year. It's really been challenging for a lot of families that I've been dealing with. And AAA is we're here as a support and a resource and advisors for all of our families that are out there. You can visit us online at aaa.com/financial aid to learn more. You can also find us under aaa.com under loans and banking. And we here in the student lending department, we're always here at any time to answer all your questions and help kind of guide you through this process. You can give us a call directly at 888-422-2536, a free advising service we offer for our members, and we're happy to answer all your student loan questions. So again, thank you everybody for joining me here today, and I hope you've found it valuable and learned a few things about our student loan programs. Thank you.